Our first half performance reflects the work we are doing on our three core pillars: growth, profitability, and capital allocation. The results we have achieved give us confidence that we can hit our targets for the year and make significant progress towards our 2021 strategic plan. As part of our three core pillars, there are many strategic initiatives that we have implemented. Let me give you some examples. Starting with growth, our revenues growth at airport was up 8% on a currency-neutral basis, driven by strong like-for-like growth of 5%, and a positive contribution from both net new openings and our bolt-on acquisition strategy. Secondly, on our profitability enhancement journey, we are pleased with Europe's underlying EBITDA margin growing by 100 basis points year-over-year, thanks to the revenue-generating actions, relentless execution, and strict cost control, without sacrificing product and service quality. And thirdly, our capital allocation strategy. We continue to look for bolt-on acquisitions that could further strengthen our leadership position, at the same time as reviewing and monitoring our portfolio. As a result, we have recently divested non-core assets so that we can be more and more focused on our core operations, as well as divesting low maturity operations in order to unlock their full value potential. We generated strong cash flow with the disposal of our Canadian motorway business, and we used this to self-fund the acquisition of Pacific Gateway Concessions, an airport retail concession company which operates about 50 stores in 10 airports across the US. This acquisition is consistent with our strategy to build a sizable convenience retail business at North American airports. In fact, the acquisition of Pacific Gateway, following the acquisitions of Avila and Stellar, together with several new wins, puts us in a solid top 3 position. So in short, we had a good start to an important year of execution with all of our priorities firmly on track.
Let's look at our numbers, which are all on a constant currency basis and pre-application of IFRS 16. In North America, we posted very good like-for-like revenue growth, with strong performance of 5.6% at airports, only partially offset by softer revenue on motorways. In addition, the top line benefited from the positive contribution of bolt-on acquisitions and net new openings. Underlying EBITDA was up more than 8%, also thanks to the new agreement we signed with American Airlines for their airport lounges. Underlying EBITDA margin was 9.7%, a 30 basis points improvement compared to the first half of 2018. Reported EBITDA was positively impacted by the capital gain of $133 million from the disposal of our Canadian motorway business. In international, we continue focusing on the completion of the startup phase of our latest initiatives in the context of slowing airport traffic, especially at Schiphol airports in Amsterdam. As a result, revenue was up 12.5% with a like-for-like performance of 4.1%. Underlying EBITDA margin decreased from 8.9% to 7.1%. We expect new business to continue to impact margins in the short term, but we also expect an improvement in the second half of the year as we continue to put our efforts on operating performance. And we have already seen this reflected in a positive start to July. Moving now to Europe, as expected, revenue was stable year-on-year, whilst underlying EBITDA was up 27% compared to the first half of 2018. As Gianmario said, underlying EBITDA margin was up 100 basis points to 4.6%, a very strong result, confirming our commitment to enhancing profitability in the region. Reported EBITDA includes an €8 million capital gain relating to the disposal of our operations in Czech Republic in the first half of 2019, while in the first half of 2018, reported EBITDA was negatively impacted by a €9 million one-off cost relating to the cross-generational deal in Italy. In summary, a solid set of results, with group like-for-like performance of 3% driven by airports, underlying EBITDA growing more than 8%, and underlying EBITDA margin improved by more than 30 basis points. As a result, the group posted a €5 million underlying net profit for the period and a €130 million reported net profit. And finally, free cash flow. First of all, in the first half results, the two key items to call out are working capital and CapEx, both of which are in line with our full-year expectations. Working capital absorption reflects the cash out relating to the cross-generational deal booked in 2018 and a build-up of receivables driven by our growth, some of which will reverse in the second half of the year. CapEx was at a high level as we expected. We continue to keep a very strong balance sheet with a net debt to EBITDA ratio of 1.7 times at the end of June.
We continue to strengthen our foundations for future growth with a continuous stream of contract wins and renewals. So far this year, we have further enhanced our portfolio with around €500 million of new wins and around €1 billion of renewals, including new wins at airports in Philadelphia, San Francisco, Baltimore and Boston, in Northern Europe in Manchester and Stavanger, in Far East in Langkawi and Shanghai Pudong. We also renewed existing contracts, including in Salt Lake City, Indianapolis and Zurich. Given the quality of our operation, we were once again recognized as the best-in-class operator by landlords, winning 10 awards at the recent FAB Awards in Dallas. Last week, we also announced an exclusive agreement with Panera Bread, a leading restaurant brand with a very customized eating experience, including low-calorie, vegan and vegetarian options. They are also at the forefront of digital innovation to deliver a better customer experience. The development of the brand onto our network will start at Charlotte Douglas International Airport and in Salt Lake City International Airport.
Given a better-than-expected contribution from capital gain on net result in the first half of the year, and assuming an average euro-dollar exchange rate of 1.15, we are updating the full-year guidance we gave you during our Capital Markets Day. We now expect a 2019 reported EPS of between 90 and 95 euro cents, while we continue to expect revenues of 5 billion euros and underlying EBITDA of 450 to 470 million euros.
In conclusion, the results of the first half of 2019 represents encouraging progress for our group as we continue to deliver on our targets. The business delivered strong growth in revenue and EBITDA, and we have a solid balance sheet. Our platform is strong, and while we are aware that we have to work on our international division, I'm confident in our ability to deliver our expected results for the full year 2019.